Hi everyone, Jade here with you for my final update of 2022. Geez, what a year we've had this year. We've seen some extremely turbulent market conditions since the start of the year. We've had our merger between Plan 4 and Y Partners that took place around June of this year, which is now done and dusted. And I just wanted to say a huge thank you to each and every one of you for coming on that journey with us, for your continued support. And I look forward to a really happy and prosperous 2023 together and beyond. So firstly, just a quick bit of housekeeping. Our office is going to be shut over the Christmas break from midday on Thursday, the 22nd of December, which is tomorrow, and we'll be returning to the office on Monday, the 9th of January. So there won't be anybody in attendance at the Y Partners office throughout that period, but if you have any urgent inquiries, I'll still be contactable over email throughout that period if needed. Secondly, I just wanted to give you a quick reminder of some of the strategy considerations we're talking about with clients at the moment. The super contribution rules have changed since the 1st of July this year, which now allows a lot of people aged 67 and older who weren't able to contribute to super previously to be able to make large contributions into their accounts. This has opened up some really exciting estate planning opportunities where we've been able to significantly reduce the tax that people's estates may pay on their superannuation benefits if they're no longer around. So when we catch up for our next review, please ask me about this and we can explore some of these avenues and see whether they're applicable to your situation. And lastly, I just wanted to give you a quick update on what's happening in investment markets right now as we get close to the end of the year. Well, as you'd all know by now, the first half of this year has been pretty heavy going. We've seen most asset classes declining in value, struggling as interest rates are pushed up by central banks to try and keep on top of surging inflation that we've seen as a result of the COVID stimulus that's been pumped into the global economy over the last few years. Between January to June, we've seen US share markets, well, the Nasdaq in particular, off around 33%, the Australian All Ords Index down around 12%, and other assets like listed property down well over 20% for that first 6-month period. Things have looked a lot more favourable since July, where we've seen share prices and other asset prices starting to recover from the low points we've seen earlier in the year. This has been buoyed by the fact that interest rate rises, both here and abroad, seem to be having a desired effect of starting to cool inflation. And we've seen this reflected in the smaller interest rate increases we've seen from the RBA here and the Federal Reserve over in the US over the past month or so. Over the past month or so, we've seen a continued rally in equity markets, with the Australian share market the standout performer, with strong gains being seen in resource, utility and infrastructure sectors. Part of the reason for the strong performance of the Australian share market has been an improving relationship with China, where we've seen them step away from some of the harsh rhetoric towards Taiwan that we saw earlier in the year, and instead focus on more of their domestic policies, such as winding back some of the no-COVID restrictions that will see their economy function more efficiently, and also providing some greater support for their embattled property sector that has been weighing on investor sentiment. And on the back of that, we've seen the Chinese share market rally around 17% in the last month. Fixed interest markets continue to be volatile. We've seen heavy losses at the start of this year, which were brought about by some of the quickest interest rate rises we've ever seen in history. Along with these interest rate rises, we're starting to see some really strong income yield from the defensive parts of our portfolios now, which is pleasing to see. We've started to see a partial recovery of some of the capital that was lost earlier in the year as the longer term bond yields start to taper off over time. That being said, we've seen markets being quite reactionary to any new information coming out from the Federal Reserve, and we expect there to be some continued volatility for some time yet to come. So, looking forward, it now appears that we may be getting on top of some of these inflationary issues that have been plaguing markets since the start of this year. 2023 is a new year with new opportunities. There's no doubt going to be some challenges from the threat of recession due to consumer spending that's dried up on the back of these interest rate rises we've seen in 2022. But this has been well documented and may already be reflected in some of the asset price falls we've seen this year. As always, we'll continue to monitor this situation closely and look forward to catching up and discussing any of these issues with you in relation to your investments at our next review. That's all from me for now, and I just wanted to take this opportunity to say thanks again for working together over the past 12 months. Have a happy and safe Christmas and New Year period. I'll look forward to catching up with you again in 2023. Bye.